ULTI ETF, the REX shares fund of funds, since inception, big income, but what's the real performance? How is it actually performed?
Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy, and today we got a very interesting video giving you some information on the REX shares ULTI. Since inception, is it big income or is it kind of a risky loss? Well, we're going to cover all that today with you. We're going to give you the insights. We're going to put it into our new drip calculator that we developed, that we want to see how does the fund since inception, how is it done? So before we get into that, I got to do a big shout out to all of our Patreon supporters. Thank you so much for being a part of us and supporting this channel and keeping it alive. And for everyone who's a YouTube member, again, thank you. You guys, again, are like Patreon guys. You support the channel, and we appreciate it. All of our YouTube subscribers, thank you. And you guys keep adding more and more, and we appreciate it. Thank you very much for joining us. If you're not part of the community, don't be afraid to hit that subscribe button, hit that like button, and definitely hit that bell notification so you don't miss a single one of our videos. Let's get into ULTI ETF, the full breakdown.
Now, before we go any deeper, I got to just give you guys a pre-warning that this video is really for educational. I am not a financial advisor, so past performances don't guarantee any future results, and this is for educational. If you need financial assistance, always contact a financial advisor or professional. So let's talk about ULTI, the eye-catching income and volatility reality. Well, the eye-catching income, this thing advertises some phenomenal numbers, 74.83% distribution rate. It's part of a strategy of the weekly payouts. And it has a great 30-day SEC yield of 18.49%. Now, it doesn't tell you is the distribution rate. It does use a total 100% capital return. Okay, so that's not part of the total return of this. And remember, on this channel, we always try to talk total returns. The volatility reality is the total return since October through March is down 31.67%. So that means 31% of your money is coming back to you. The year-to-date rebounds, well, they're showing some big rebounds, but it's so early when we're talking year to date. We're only talking maybe a month so far. So the NAV has declined significantly since the inception, right? So what is ULTI actually? It's a fund of funds. It's that core objective. It's targeting high volatility U.S. stocks. It's generating that weekly income through options. And it's adaptive positioning based on market conditions. Okay, it's using 20 to 30 volatile stocks and generating that income from those options. This fund did come out October 31st of 2025. This one is really was competing with ULTY from YieldMax. So it uses the covered call strategy, which many of us understand. It's used a put selling. So it sells put options for the income, and it rebalances its position. So giving you a quick snapshot and the key stats of this, the expense ratio is 1.25%, which basically is $125 off of every $10,000 invested. So that's 65% higher than the defined outcome ETF average. So it's an extremely high expense ratio. It is a weekly payer. It has assets under $17.53 million. And the net asset value right now is $16.23 as of January 29th. The top 10 holdings of the fund, concentrating 50% of their fund, is only in 10 funds. It has 101 different holdings, but primarily 50% of it is in only 10 of the holdings. And it keeps 32% of the cash on the sidelines. So the performance since inception, this is the magic, the big picture that we talk about. Total return, 31.67% loss since October 31st. Okay? Oh, terrible downgrades. Year to date, so this is really giving you a snapshot of January. The rebound, about 14% gain. And then in December, its NAV loss was down 13%. So I kind of put this in a chart. You can see if your investment was at 0% when you invested into it. December was down 13%. Dropped again by the end of January. It was down 31%. February, it's starting to come up. February, it's starting to make its change forward, being down now only 17%. But currently, we're looking at a negative 14% at the time of this video. So you can see it's it's so new, it's not finding its legs, it's not finding where it's supposed to be at, and the performance has not really been there. So this distribution reality check, the 74.83% distribution rate, the distribution rate does not represent total return. So I always got to verify that with people to understand you're not getting 74% because it uses 100% return of capital, which is giving it to make sure it can pay out those distributions on a fairly regular basis. So what does it really mean? Well, I've done a video on ROC, and it's well worth watching because it's got so much information into it. But short version, it reduces your cost basis. It kicks your tax can down the road. Okay, NAV erosion, the fund's value decreases over time, and its unsustainable payouts is why they use ROC. So is ROC a red flag? Well, you got to understand the reading to it. If you're watching your NAV drop and drop and drop, yes, you have a NAV issue. You have NAV erosion, and ROC is definitely part of that. So what I did here is I said, let's try this out. I developed my own drip strategy. I've kind of put this into it and said we can do this on almost every fund. But over the past 3 months, we created this, and I said, let's take a look at it. $10,000 invested would have bought us 377 shares at $26.50 a share. If I put all 100%, took every dollar of distributions, poured it back into the fund, what would we have received? Well, we would have been able to receive 74 additional shares. Okay? But the portfolio growth is still down 23.88%. Now we're averaging about $450 a month. Even though this is weekly, I put it into monthly and saying how much a month are we getting? About $450 per month. Now, again, in 100%, you're not getting that money. It's just showing you how much money you're actually being able to buy additional shares. The portfolio lost 23.88%, which is not good at 100% drip. So it means you're losing more than you're actually going to put into it. I turned the page and said, how would it do if you did a 50% drip? Well, again, you're only adding 35 shares to it, and your fund is still down 27%. So realistically, you're getting about $200 a month. These are just terrible numbers. They're just not surviving. And then we go to the zero drip strategy. Well, over the past 3 months, you would have collected about $1,164 of total income. Your $10,000, your value of your fund, your $10,000 would be worth $6,369. That's down 36%. So realistically, all that money is your own money that's just paying it back to you. And it's actually less than what the fund's taking a big chunk of it as well. So I really tell people is that this whole thing of $400 a month, is it really worth it of a $10,000 investment? This fund is not driving the way that anyone could ever think of. So the current year, are we talking recovery? Well, I did something different with the fund, and I threw $20,000 into it because we're going to need more funds to recover with, and we can buy more shares. But if you would have stepped in January and bought into the fund, well, you're up $872, or excuse me, $870. Okay, your portfolio would have been up 4.96%. So now the question is it timing? Is it really timing, or is it really the fund doing better? Well, this is the reason why I showed this, is because I've always said on the channel, you need to wait 3 to 6 months before investing into a fund to find out what it's actually doing. Well, and I turned this one and said, look, you're collecting nice distributions, you're gaining in the portfolio, you're actually doing good on the first month of the year. So is it timing? I don't think it's still timing. What I really think it is, it's just having a good month. Because look at what happened at the end of February. It's dropped off dramatically. So we would have to run another one in February to see where we're at. And we probably will, to give you guys an idea of, if the first 2 months of the year, is this thing actually doing what it's supposed to be doing? So I always ask, who does this actually fit? Well, I put it to you as this: it's that savvy investors, the ones who understand that based income strategies. But you have to have a high tolerance for sharp drawdowns and price swings. And I'll tell you, total focused return people, anyone who sits there and says that, I'm getting 76% return, yield return, you got to regroup yourself and say, look at total returns as a whole. And I think that if you're looking at total returns, probably not a fund you're going to be ending into. The big one, who doesn't it fit? Anyone who wants stable principal needs. So if you're in retirement and you want to keep your principal because you want to live off of it for the rest of your life, this is not a fund for you. This is not a safe income inception. This is one that weekly payouts are not guaranteed. They're not safe. You don't know what you're going to get. And majority of it you've seen so far is your own money coming back. Any conservative retirement core product, this is not it. This is a high risk, they'll say high reward, but it's a very sophisticated program. And it's just not one for the retirees across the board. So the professional monitoring frame things you got to look at with this is the NAV trend is it's been declining. The total return is you got to watch your price and distributions, and since inception it's down 31%. So it's like a strike one, strike two. And distributions have been 100% ROC, that's strike three. So if we're playing baseball, 3 strikes and you're out. The fund size is growing because it's exciting. People are chasing yield and putting money into it. Is the market regaining? Well, because it's selling cover calls, it's not going to grow as fast as other funds, the way the market has gone. So there's going to be some issues there. And then the monitoring tips, you really have to focus on that total return, the return of capital, and monitoring the volatility of the market. So I give you my own personal opinion onto it, and that's all it's worth, because I'm not a professional, I'm not an investor, I don't own this in any way, shape, or form. I look at this one and tell you straight out, it's my 3 strikes and out program. The NAV is declining, total returns are not even positive, and you're 100% ROC. If I want my own money back, I'll just go to the bank and get my own money and call it growth. It's the only way I can tell you. So the bottom line and the big income, the real risk that you're facing is as simple as this. Anyone who tells you that you have the big income of 74% don't understand what they're doing, because in reality, they're losing 31% of their value of their funds. Plus, you're paying an extremely high expense ratio. So the discipline of this one, track your returns, not just your yields. Monitor your NAV. It trends weekly, and use it as a satellite, not a core holding. This is one, if you really want to be in this and you really believe strongly in this fund, this is one that you put into your high risk, high category, which is probably no more than 5% of your total net value and net worth and portfolio value, no more than 5%. And you put it into this and you say, hey, you're going to Vegas and we're gambling. You're going to the roulette table and you're putting your money on black, and let it ride. That's what you're doing with this. So I want to tell everybody out there who's looked at this or any part of it, and all of our viewers, man, if you're into this one, I don't know what to tell you. You got into the wrong category of 74%. The total return is not there. But if you're looking at it, it's kind of one of those situations. Understand what you're getting into. So let me know in the comments below. Love to hear from you. What do you think of ULTI? Rec shares has always been a good one for me. I liked how their policies have been. They use that 50-50 blend, but this one's a totally unique duck. It's a totally different package that they're using. So let me know. Leave in the comments below. Do you own this? Do you not own this? Are you interested into it? Not interested into it? Love to hear your comments. Most of all, if you like the information we're giving you, hit that like button. It helps the channel the most. And if you're not a member, don't be afraid to hit that subscribe button. Join the family, join the community. We'd love to have you. Thanks, and we'll catch you next time.